In 2023, Americans dealt with soaring inflation, high grocery and gas prices, rising interest rates, but somehow the United States managed to stave off a recession.
Bankrate's chief financial analyst predicts that rates will decline gradually over the coming months and eventually reach 5.75% by the end of 2024.
During the depths of the pandemic, we had mortgage rates below 3%. And the outlook is that the Federal Reserve itself will be bringing interest rates down as we get through this year.
Holding interest rates steady, the U.S. Federal Reserve signals it's done with hikes at its last meeting of the year in December.
We are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see.
You know, it's not so much we need those cuts, it's that Powell said if there's going to be some slowdown, I'm ready to cut. That willingness to cut is more important than having the cuts.
My name is Nick McLean with 4 Pillars Investors, the most boring guy in private equity, but with 15 years of experience in private equity and mergers and acquisitions, I at least have a little bit more insight than some of the other folks out there. There seems to be some level of consensus that interest rates will indeed fall in 2024. Now, we don't know the magnitude, how many decreases, when they will start. What I will tell you is that, generally speaking, falling interest rates are good for the economy. The cost of money is cheaper, therefore companies, individuals, etc. are more willing to put that money to work, or in the case of consumers, are more willing to take on debt to fund purchases that they might not otherwise make. I think it's important to note that if you look at historical levels, interest rates really aren't that high right now, right around average or maybe even a little bit lower than average. We always have this desire for interest rates to fall. I think it's important to keep in mind that if we're only looking at the past 5, 10, 15 years, we're really in a period of extraordinarily low interest rates. Even though it feels as though interest rates are high right now, it's not really that they are high, it's just that they've risen so much from where they were in previous periods. If you look at why the Fed was raising rates to start with, it's largely due to combat inflation. Now, the general view is that inflation is in check. I think prices declined in November for the first time in recent memory, which is all good. Because of this, that's what starts to open up the discussion about a potential lowering of the rates. However, there's the concern that interest rates are not just being lowered for that, but they're actually being lowered because of potential recession fears. If you look at the market, if you look at how the markets move and whatnot, so much of it is based off of perception and expectation and fear and uncertainty and whatnot. That's why there's at least the potential to have a negative economic result from lowering of interest rates. If for some reason there gets to be this general consensus that the reason that the Fed is lowering rate is purely due to these recessionary fears, that might be one of the few factors that would lead to an actual worsening of the economy and then, subsequent lowering of interest rates. One area in which interest rates are particularly acute is in M&A and private equity. There's been some articles recently in the Wall Street Journal talking about how low deal volume and deal making has been, especially in the private equity sector in 2023, going on to get quotes from some private equity executives saying that the pace of acquisitions and deal making in 2023 really can't continue. And on top of that, many of those same executives or others have commented that they really made the conscious decision to sit out 2023, knowing that there was so much uncertainty and unfavorable interest rate environment. So with all that having occurred or in 2023 and that kind of being the mindset, 2024 certainly seems to be like a year that could be a really big one for M&A and private equity. On top of that, you have some continued tailwinds. Your private equity continues to have substantial dry powder to make acquisitions. On top of that, it's the continued demographic trends of business owners specifically getting older, wanting to transition out. On top of that, you have the seller state of mind. Look at what we've all been through over the past 3, 4, 5 years. I mean, it's been a very turbulent environment. Business owners specifically, got through the pandemic and they are getting back to a point of normalcy, if you will. What's going to happen next? Is a recession on the horizon? Well, many business owners probably feel that possibility. Now, what's interesting is that for 4 Pillars in 2023, we didn't sit on the sideline. We actually executed a bolt-on transaction that was very meaningful to one of our businesses, and it was really a transformative acquisition. Not always true when you talk about bolt-ons. And also for us, when you look at 2024, we're working on a very meaningful acquisition right now that we hope to close in probably late Q1. Now, this is not at all to say that 4 Pillars is doing so great. I really just want to be as honest as I can, and if things were going terribly, I'd tell you, I really would. But the point here is just a general disclaimer that just because the broad trends are doing one thing doesn't mean that has to dictate what you do with your business. So what do you think? When specifically do you think the Fed will lower rates, and how much? Now, I'd love to have a comment from you, but here's my email address. Email me. Let me know what you're thinking. Let me know how your business is doing, because everyone's experience is different, and we're still looking for acquisitions. We're still going to be looking for acquisitions next year and the year after. So I'd love to hear from you. Thanks for watching.